Hi, this is Victor Young of Admiral Investment. In the last 2 weeks, we have discussed the basic nature of net asset value, the first step of valuation. This week, we will discuss fair value. Basically, net asset value is static and values only the present. Fair value is dynamic and forecasts the stock's income potential. Before we start, let's go through two basic valuation theories. First, the worth of a security is the sum of all its future cash flows, discounted by an appropriate discount rate. This is known as a discounted cash flow or a DCF valuation. DCF valuation is a theoretical basis of all valuation methodologies. Typically, other methodologies are developed to either speed up calculations or to simplify the assumptions needed to create a reasonable valuation. This is true even for NAV, which does not explicitly mention cash flow. Second, money has a time value. This notion, formerly known as the time value of money, means that a dollar today is worth more than a dollar tomorrow. How much less the future dollar is worth is tied to the investment risk. A future dollar from a government bond is more secure than a future dollar from a venture capital investment. Thus, a government bond has a lower discount rate than the VC investment. The worth of the future dollar is also tied to the amount of time until it materializes. Getting a dollar from an entity in a year is more secure than getting a dollar in 10 years. This is why longer loans usually carry a higher interest rate than shorter loans with the same entity. Discount rate is the conversion factor that takes into account of the risk level and time length. It is usually expressed in percentage terms per year. Thus, a discount rate of 5% for a particular investment means that receiving a dollar next year will be worth 5% less than cash today. The present value of a cash flow is simply the worth of the future cash flow in today's dollar, discounted by an appropriate discount rate. It allows an investor to compare cash flow across different investment types, since present values has normalized the risk and investment period. For an instrument with a predetermined life, such as a bond, a full DCF model is usually used. A 10-year bond may pay interest every 6 months, resulting in 20 cash flow streams for the interest payments and a return of capital at the end. A DCF valuation of a bond is simply the sum of the discounted cash flow. Note that a DCF valuation does not model the asset base of the company. Under a DCF valuation, an asset is only worth as much as its ability to generate income. This is in direct contrast with net asset value, which values the asset base of a company without explicitly valuing its cash flow. This is why NAV only makes sense when the assets themselves are traded outside of the real estate market. Real estate assets, for example, have market value because investors have realistic expectations of how much rent is generated from a particular real estate asset. In fact, private equity or corporate investors will typically do a DCF model to create a bid price when they buy a building. NAV is therefore rooted in the DCF valuation because it relies on the observed real estate prices. This linkage between real estate prices and cash flow generation validates a NAV calculation. But NAV is static. It calculates the worth of a company's asset base, which reflects how much income the company may generate as of today. A company is an ongoing entity. A management strategy is the set of actions that modifies the asset base to generate more earnings. A more precise valuation, therefore, will value the company based on its future's earning power. The management may, for example, buy more assets, take on asset enhancement initiatives, or sell some assets. Each of these strategies will modify a REIT's asset base and change the REIT's income. Future NAV will also be changed because of this. Fair value is dynamic because it forecasts and values a company's cash flow in the next several years. This is why fair value is often, but not necessarily, based on DCF valuation. A good fair value accounts for not only the announced strategies, but also likely future actions. For example, a good analyst does not know which building a REIT may buy next, but based on the knowledge about the market and the particular management team, he can estimate the basic profile of the next acquisition. The usefulness of fair value is crucially dependent on accurately anticipating corporate strategies. Next week, we will go through some modeling techniques that links the NAV to a fair value calculation.